More people are paying attention to crypto right now than ever before, so it's important to get your information from the sources you trust. That's why I want to give a big thanks to Bitwise for sponsoring today's episode. Bitwise manages over $10 billion across more than 30 crypto strategies, and they've been doing this since 2017. But here's what really sets them apart. They give back too. Bitwise actually donates part of the profits from its Bitcoin and Ethereum investments to open source developers, the people building and maintaining the networks that we rely on. So when you work with Bitwise, you're not just getting professional crypto exposure, you're helping fund the future of crypto itself. Check them out at bitwiseinvestments.com or email james@bitwiseinvestments.com and tell them Raoul sent you. Thanks. Let's get some facts. 37% of you aren't subscribed to this channel. That's almost 4 out of 10 just freeloading the alpha. So come on, hit subscribe and I promise to keep leveling up the show with the best guests and the juiciest insight. Go on, do it now. Hi, I'm Raoul Powell and welcome to my show, The Journeyman, where I travel to that nexus of understanding between macro, crypto and the exponential age of technology. You know, it's a real privilege to be in the seat that I am, to have the network that I have, and how Real Vision pulls this all together. One of the people I love to talk to is Chris Boniski. So Chris is one of the really great thinkers in the space. He has been an inspiration to me in how he deals with the ups and downs of markets and how he invests. Now, the value in a conversation is exploring not only the similarities of views, but the differences. And Chris has different views to me, and I want to hear them. Because Chris thinks the cycle's possibly ended. Now, we both think in probabilistic frameworks and no certainties. I think the cycle extends. So we want to explore the differences and then how people can deal with having two different divergent views and to put that into your own framework. You see, Chris is really good when it comes to the psychology of investing and how to think about it and how to think about managing your portfolio for success that you need to survive and thrive. So let's hear from Chris. Join me, Raoul Powell, as I go on a journey of discovery through the macro, crypto, and exponential age landscapes. In The Journeyman, I talk to the smartest people in the world so we can all become smarter together. Chris, good to see you back, my friend.
Thanks for having me on again.
Yeah, look, I mean, here we are. Today's the 13th of November. I guess this will come out a week later. And the market, crypto, Twitter, everything is kind of in turmoil, trying to figure out where the hell we are. So I think we'll start with that and then we'll dig into the more interesting stuff afterwards as well, what else you're seeing. So how are you thinking through where we are in the cycle or in the markets or the structure of them?
Sure. As of today, Bitcoin's down about 20% from its highs, right? And so in classical finance, this would be a bear market, right? Within the crypto industry, it's Thursday. Either a speed wobble, or it's going to go further, right? And I think that we have to have a healthy amount of respect for Bitcoin just always being the center of gravity of what other crypto assets are doing, right? And so there's a lot of ways to look at this, right? And I think that's what's agonizing for people. And you and I are gonna, probably talk through different views here that we both know are probability weighted in our own minds, and we're both prepared to be wrong about those views, right? And that's where a lot of the nuance is lost online, because people either want you to be a bull or a bear, whereas I feel like every professional asset manager is always some combination of bullish and bearish, or bullish and paranoid, or bearish and paranoid, or whatever it might be.
Yeah, generally is if you have a pretty strong view, then your entire job is to be paranoid about that view. That's how I think of it.
Yeah. And so, in kind of the simplest framework where, and this is the 4-year cycle framework, then Bitcoin is in the process of topping if you follow that 4-year framework, right? And then you would expect a bottom about 12 months from now. And you could say that that's due to halvings, which I think gets more dubious as Bitcoin's inflation rate diminishes, and you really think about the crux of the halving argument, and the amount of coins that goes to miners and proof of work and the cost to produce Bitcoin and all that. So there's the halving argument, there's the liquidity argument, which you've done a great job of educating people on, and Bitcoin kind of aligning with 4-year business cycles, and then the liquidity cycle on top of the business cycle. This is where it gets tricky, right? Because right now Bitcoin is deviating a bit from the liquidity cycle, right? And so I think we have to acknowledge, for me, that is a point of paranoia, right? Where I'm like, hey, the liquidity cycle would suggest that Bitcoin should at some point here do very well. Right now it's struggling a bit, but I can't ever get too confident in that view, because I know that I could get my face ripped off if I'm not allocated enough to the upside, and liquidity dynamics kick in. But I would say, kind of for me, overarchingly, the reason I started to sound some caution, let's say, after really the 10-10 crash, was the market was just feeling heavy to me. And there was someone who put a comment on crypto Twitter of, one way in which I look at markets is kind of as an organism, and I'm not as kind of like focused on some pinpoints, and I'm not as deeply trained, for example, as you are on some of the detailed nuances of markets, right? And so then what I'll try and do sometimes is just step back and look at the organism as a whole and take in all those variables and say, okay, what is the mix of these variables suggesting? And so for me, we started to feel weird when really Solana was not getting that much of a bid from its DATs and then anticipation of its ETFs, right? So you kind of had, you had Sailor and the Bitcoin DAT bid, which then went into the Ethereum DAT bid. You also had the Bitcoin ETFs and the Ethereum ETFs. Those two, those events were phenomenal for Bitcoin and ETH. You would have then expected the similar events to also be phenomenal for Sol, which, for me has been kind of the high risk asset of choice this cycle, right? And you've focused on Sui, I focused on Sol, pretty similar.
I had Solana earlier on and then did the switch, but yeah, completely.
Right. But like just thinking of a high performance L1, great, core engineering, interesting ecosystem. And so then when Sol was heavy through the DAT anticipation and then the pipes getting announced and kind of the announcements of those vehicles, and then heavy with the ETFs, that started to feel very weird to me, right? It's like, well, there's not a bid here and there's clearly a lot of selling if Sol's not rallying. And then that 10-10 liquidation, I mean, the only thing similar that I've seen was March of 2020, the COVID crash, and you had assets, like I looked at the portfolio that day and, assets were down 60 to 90% on the day at a point in time. It was insane. And so what I didn't like about that was, okay, this cycle, there's been a lot of angst around really in the long tail, right? Where's the bid in the long tail? What's the fundamental value in the long tail? How do you value these things? I would say things that we have anticipated for a long time, right? Like the professionalism of valuing crypto assets, and you and I have both, been early to trying to figure that out. Well, it's coming now, right? And so the long tail's not getting a bid. There's an AI bubble, and then the 10-10 crash revealed for a lot of assets where an organic bid materialized. And my paranoia in those wicks is, do we have to go back to those wicks, right? And some of those wicks suggest, bear market levels of where, especially in the long tail.
Yeah, I mean, it depends which wick, because if you use the Binance wick, that's pretty bad. If it's the Coinbase wick, I mean, a lot of these are going back to that right now as we speak.
100%. And so, that's another piece of nuance within this. And then there's other things, like you mentioned Binance and Coinbase. So the Coinbase premium has evaporated here, right? So Coinbase coins tend to be trading at a discount right now to Binance, which tells us the US bid isn't there in the way that it once was. We're starting to see some of these really aggressively priced venture deals, even though there's not really a venture bubble in crypto.
Chris, just to go back 1 second about that, the flash crash liquidation event, who really got damaged there? Because somebody got really damaged in all of that, but it's not clear who, because most US aren't highly levered, they're not using Binance.
Yeah.
People obviously got liquidated, but where was the real damage in that?
I think we're still yet to find out, right? There have been, I don't want to propagate rumors. I'm sure we've all seen the rumors on crypto Twitter, and I don't have any like definitive information, but there's certainly questions being asked of certain market makers.
Did it hurt retail? Or did retail just kind of watch it in horror? I mean, that's what I'm kind of thinking. Have we done something some psychological damage to people? Or was it just an observational, what the hell just happened, like the flash crash in equities back in 2016 or whatever it was?
Yeah, I think there was some damage done to anyone who was levered, right? And especially if you were levered according to Binance prices, right? There's for sure damage there. And so that would be some retail participants. But I think probably the more important damage is there was already a pause in the long tail bid, and I think it just gives further pause to the long tail bid, right? Because all of a sudden, even if there's this discrepancy between exchange pricings, people are asking where's the bid in the long tail, and then there's this, calamitous event that shows some of these horrendous wicks, and it really does cause people to say, well, is that where the organic bid is? And so I think that's the psychological damage.
And another thing that you raised, which I think was an important point and not widely understood, is you kind of suggested maybe there's a sort of mimetic reflexivity to the idea that it's the 4-year cycle, stupid. So everyone just makes it happen. You kind of manifest it via hyperstition.
Yeah, and this is such a tricky one. I try and go with, hey, this time isn't different until there's a strong enough reason for it to be different, right? And we see that play out in all kinds of ways, right? And the reason things are never different is because human nature never changes, right? And you and I know that well. There are a lot of reasons for this time to be different, though, right? Like there's sweeping legislative action and regulatory clarity in the U.S. There's major traditional finance and traditional tech embracing of stablecoins and blockchain technology. There's ETFs in the market for the majors for the first time. Liquidity is coming our way. So there's a lot to suggest that, we could turn a corner here. And I'm prepared for what it's worth. Like BTC right now is 98. ETH is just above 3K. Sol's 140. I'm prepared for things to turn around from here. It's possible.
Yeah, because remember 2021 was a wild one for that. I mean, BTC went down 50% and then straight back up. I mean, that was not easy.
Yeah, and so like here you're looking at BTC down 20% from its highs, ETH already down about 40% from its highs, and depends on which high you want to use for Sol, but from the December 24 high, Sol is down about 50%, right? I could see that being enough of a washout. I could see that if we rally from here, I could see that being very painful for a lot of people, right? And this again is like one of my fears that I see on crypto Twitter is it's so all or nothing. It's so like full port, 100% in, all systems go, versus, I shared this thing, a month or so ago of, hey, I'm about, 39% cash, right? 61% long capitalism. And there's a basket of assets that goes into capitalism, and crypto assets are part of that for sure. But so like, I'm still majority long capitalism, and I basically always want to be majority long capitalism because capitalism is designed to grow capital, right? And then, you incrementally raise cash when times are good, and then when prices get interesting enough, you deploy that cash. And, right now, money market funds yield more than inflation costs, and so, accruing bit by bit some purchasing power. It's nothing, special, but I would really encourage people listening to this call, if they're really agonized about the current situation, to think of it kind of more probabilistically and more piecemeal.
But Chris, I think the issue is look, you had a very good entry on your positions.
Yeah.
And therefore your ability to take money off the table, considering Solana didn't go to new all-time highs. I mean, this would be, I would put it in the paranoia bucket for this case, is like we had no new highs in everything except Bitcoin. And pretty much the whole space topped in January. That's weird for this year. But the issue is people don't have any real significant gains because most people never buy the lows, right? That's, we both were pounding the table back in the lows, but most people haven't bought the lows. So they buy sometime in 2023 or 4 and they're not up, they're flat.
Yeah.
And that's really hard psychologically to take chips off the table when you're flat and all your hopes and dreams are in this trade. So I can see why everybody's agonizing because it's difficult.
Yeah. And people will discount, at least me, for having venture entries, but a lot of my entries are public market entries alongside everyone else.
Yeah, your Solana was, fantastic. And that was a public entry and done publicly in front of everybody.
Yeah. And then, I think, for anyone that I'm helping on a personal basis enter crypto assets, I just always tell them, if they come out flat in their first cycle, that's a win, because they learn so much in that process and they go through the agonizing volatility. And so if someone is, flat and having learned a ton, then that's a win. And that's really how I would think about it. Now, if they're flat at these levels, I can see how that would be difficult, and one framework I've been encouraging people to use, and these are just friends, and people I care about that have their own portfolios. And when we have conversations, I try and share the best frameworks I can. One of the things I've been using is, okay, let's say you sell here, right? How are you going to feel? How good are you going to feel if it goes down versus how bad are you going to feel if it goes up? Now, let's say you don't sell. If you don't sell, how good are you going to feel if it goes up versus how bad are you going to feel if it goes down? And use that quadrant, because you can compare the good and the bad feeling for opposite actions and opposite market moves. And you don't want to be too emotional, but for me, I think it helps people think about where they would experience more emotion or remorse or regret, to just anticipate that future reality so that they don't do something stupid in the future.
And I think for a rational investor, somebody who's thinking carefully about trying to build wealth, that matrix works well. The issue is the younger investor who can't buy a house, that kind of, there's a desperation around the whole thing, right? This is like, this is my only chance, the unfuck my future idea. And it's so strong in people that their entire hopes and dreams are in a trade, which is obviously never the right way to approach any investment. But that they would kill themselves if they miss the upside, but they can't also bear the downside. And I think that's what we see with this excess emotion in the space, is these two things, these two competing forces are literally driving people insane.
Yeah, no, I think that's very well said. And yeah, what I would layer in is layering in the need for instant gratification, because like when I came as a professional to the industry and started working at ARK in 2014, I had, less than $10,000 to my name. I didn't have much, and it was a different industry and a different opportunity. But, it started by buying relatively small amounts of things and learning and like incrementally. And then I got wiped out, for example, towards the end of 2016. I went through a hack and I got pretty fully wiped out right when I was starting to write crypto assets, and then entered 2017. And so
how did you deal with that, by the way, mentally?
It was horrible because I was a early SIM swap victim where they shut down my account at one mobile provider, opened it up at another mobile provider, used that to reset my Gmail, then used that to reset my Apple account. Then, all my devices got wiped, and then I was locked out, and then, it was a horrible experience. So I have much better operational security now, and so I'm thankful for that. But that was horrible. I mean, psychologically, getting wiped out, felt like just a lot of wind out of the sails. But then also, when you go through a cyber attack like that, it's really hard to be certain that those people are out of your digital house. Whereas if someone breaks into your physical house, it's easy to know they're out. But it's harder to get that sense of security that they're out. But there's always silver linings to these things, and so I learned a lot about cybersecurity from it. And
how did you get your mindset back to dust yourself off and say, well, I can do this again? Because I think this is just great advice for people, just to learn how you've done it. I think failure is the best thing to learn from, not success.
There was no choice. It's like you can sit there and like moan and whine and abdicate your responsibility to other people, or you can be like, yep, that happened to me. That sucked. Like, some of it was, the universe's fault. Some of it is my responsibility. I gotta, upgrade where it was my responsibility, and then roll up my sleeves and do it again. Right. And so that, I would say it's just, and that's something I would encourage for young people of like, yes, the world is really tough right now, and I can feel the angst. But also, like, in a number of ways, modern life is much easier than it's ever been. It's psychologically tough.
You lose everything in a hack, and then you're like, okay, look, I'll just have to get on with it. Life goes on. Did you change your trading style and become more risk averse? How did it mentally affect you as you were trying to rebuild wealth again? Because we've seen people go through wipeouts, and whether it's a hack or just making the wrong investments, doing stupid stuff, using leverage. I mean, somebody somewhere is going to be sitting on a total wipeout from 1010, and they're going to be thinking, well, how do I ever get through this again? I'm 26 years old, and I've blown my 50 grand that I invested in this cycle and made money.
Well, I would say I got fortunate because Ethereum was in decline in that period after its DAO hack. So DAO hack was like summer of 2016, if my memory serves me. And then Ethereum was like bleeding into the end of 16. And so I was able to like rebuy a healthy amount of ETH, because it was like, when I look back on the value of all these things now, it was really the ETH loss that was very large, because I was able to be early ETH and not so early Bitcoin relative to my purchasing power. Right? If I started paying attention to Bitcoin as a professional when it's in the hundreds, 200s, but ETH is in the dollar range, right? My purchasing power got me a lot further as a young person with ETH. And so then I was able to reaccumulate some ETH, which then served me well in 2017. And then we went through the ICO craze, And the funny thing is, like, pretty much every ICO I invested in, I lost money in ETH terms. I mean, you feel like you make money, right? But you're like, this is amazing. Like, everyone's just making money. Everything you do and touch in 2017 feels like it's making you money. But then, it all falls apart again in 2018, 19. You go back and you look at those trades and you're like, oh my God, like, I lost so much ETH being an idiot thinking that I was being a genius. So there have been other cycles of me being an idiot and having to recover. And so
I even tested myself in this, which was like, I was only going to let myself have up to 10% stupid shit, super high risky stuff, memes or whatever, just because you want to be involved sometimes. Because if not, I don't really trade. I don't do anything. So I recently checked, and I think every single position I did in that kind of part of my portfolio, I lost money in.
Yeah.
Every single one. And I kind of wanted to prove that to myself, that most of the time it's a loss, versus if I just held the Solana I flipped out of or whatever, it was dumb.
Totally. And so, yeah, like, in terms of picking yourself up off the ground, I think it is just relearning, retooling. Something that you made me think of just now is Lynn Alden has a good piece out there called "Most Investments Are Bad Investments," right? And let's say you get wiped out. Well, maybe you got released from a bunch of bad investments, and maybe you can use that to let go of those in a way that you wouldn't have been able to otherwise, learn the lesson and consolidate in good investments. Because I think, the history of a lot of crypto asset investing is there are, a few dozen really big winners and just a handful of like the majors that have like compounded multiple cycles. And then a lot of other things are one cycle wonders that end up being distractions. And so with the one cycle wonders, if you're not really tactical on timing, you lose money. And then you really, for the long-term game, do want to be just building your units and compounding in the things you most believe in, while making sure that the chart is confirming that this is, an asset that creates value, right? So an asset that goes up and to the right with higher lows each bear.
And one of the issues is, and I still want to come back to the where we started, but the other issue is the long tail.
Yeah.
Because the long tail's getting longer because there is so much issuance and people become so believing that the long tail is their 100 or 1000x opportunity that they miss the main trade. I mean, the main trade for the last 3 years was Solana. It's a pretty straightforward trade. Massive on-chain activity, developer activity. It was pretty obvious. And most people missed it because they wanted to go even further out the risk curve.
Yeah.
And the long tail is now oversaturated with stuff. And so you can't even use the power law anymore because there's too many tokens.
Totally. Yeah. Yeah. It's been issuance from the, VC industrial complex, issuance from meme coins. We're definitely drowning in tokens. And, really where we felt that if we step back with this cycle as a whole, right? Most assets bottomed December-ish of 22, right? And then 23 kind of wobbly until October of 23. From October 23 to the end of Q4, we ripped. And that was alt season for most coins. End of Q1 24, after the Bitcoin ETF gets approved, Bitcoin's, doing well, everything's doing well, everyone's hopeful, everyone's like, oh my God, this is all going to happen again exactly as it happened last time. That was the peak, end of Q1 of 24. That is also around when meme coins started to become more of a thing, right? And you started to have a lot more issuance, and then you started to have a lot more concern around FDV, fully diluted valuations, supply from VCs as well, which I think is good that people have educated themselves on. And then now that's basically resulted from that peak in Q1 of 24 to basically a painful bear market for most assets from that place downwards. And, I think now it's really like a process of consolidating your portfolio, taking losses where you have to take losses. People think that you and I maybe never lose. We lose all the time, right? It's a matter of taking those losses, booking them against your gains. You net out your gains for the year, you pay taxes, you roll again. And I get it that starting with $1,000 or $500 or 5,000 or 10,000 or whatever it might be, it can feel too slow. But I would say that compounding wealth over time is a boring exercise. Like, Warren Buffett is not the world's most exciting man, but he is, one of the world's richest men for a reason. And he's kind of boring and consistent and plodding, in how he goes about things. I think, for example, Elon Musk is more of an example of like how grand and high risk you can be. And, maybe more young people look up to Elon than Buffett.
The issue is a lot of younger people have been brought up on gaming and adrenaline culture. The internet is all about dopamine. And so they naturally gravitate towards the traders on Twitter. And the traders are like, I bought it here, scalped there. Oh my God, I made a 10x in this and that. And we know that, well, I know very few traders who ever make money over time. It's very, very, very hard to do. But people gravitate towards that because they can see that, Ansem has made, a 10x in whiff or whatever, and they want that. When really slow and steady wins the day. Just extend your time horizon, don't do anything, gives you much less of a chance of screwing it up. Particularly if you're owning a decent sized layer one, your probability of going horribly wrong is pretty small.
Yeah, totally. Well, and I also think within trader culture, I think there's a lot of tendency to flex profits, and I worry that there are unreasonable expectations that are set around profits, and I think that there's a fair amount of like false flexing, right? Of outsized profits that are shown that aren't actually real, right? Like access to Photoshop through LLMs is, remarkably easy these days. And so I think that mixes in there. I would go so far as to say for most people, if you're getting started in crypto, you should start with a 50% minimum Bitcoin allocation. And then you can give yourself 50% everything else. And if you buy the Bitcoin at the right time, if you buy Bitcoin around the 200-week simple moving average, basically never sell it, and just hold it and have that as your anchor. Because then you're always long the industry, and then you can learn, you can be calm, you're long, you'll go up and down with the cycles, but you're calm and long, and then you learn, and yeah, you can add more juice to that portfolio if Bitcoin's back at its 200 week, and then you might look at the Sols or the ETHs or the SUIs or whatever it might be, right? And you might add to that portfolio, but then when things are stretching, you might take cash, and use it to reaccumulate again when you see Bitcoin's near its 200 week or under distress.
And also I try to teach people this don't fuck this up idea, which is only have a small amount in the long tail. So if you use that barbell, you're going to have 50% Bitcoin. You won't go wrong. You're going to have 10% where you're going to learn stuff, and you're going to learn a lot of hard lessons. You might make one win and you might think you're a genius, but generally you'll learn hard lessons. In the middle, just, again, don't take too much risk with that middle capital either. It's all right to go a little bit further out the risk curve, ETH, Solana, whatever, but don't go too far out because there's a lot of regret within that. But the minimum regret portfolio is that, is, as you said, majority Bitcoin, small tail, and then something sensible in the middle bucket that has potential decent growth, but no existential risk.
Right. Yeah. And if you're anchored to Bitcoin, I think it gives you a lot of kind of grounding within where we are each cycle, and your exposure and the feeling of, okay, well, things are at lows or things are at highs or whatever it might be. So hopefully people do that. And, there are complements to Bitcoin, like Zcash, has been on a tear here.
We'll come on to that one in a sec. I just want to finish off our conversation about like where we are. So you're looking at the kind of structure, the feeling, the nuance of the market, and you're like, it doesn't trade great. The things that don't add up, and there's some sort of maybe reflexivity or mimetic power around the 4-year cycle that causes people to cause this to happen, because we've seen a bunch of OGs selling, because why wouldn't they? If they bought at $10 and they're selling at $100,000, it's a sort of a round number, and they've always sold at this time of year and it's always worked. And then we had the structural break in markets in October that could have caused more damage than people yet see. So we could be, probabilistically speaking, at a top point, and people are it's kind of 50-50 split right now. It seems that people think it's topped and others think it hasn't.
Yeah, and it's not a euphoric top. It's like a distribution top.
Well, because the weird thing is if we go back to your paranoia points, which I think is a really nice one, what's the paranoid opposite of your view is we have no new highs.
Yeah.
In
no new highs, gold going crazy, liquidity coming our way. There's a lot to suggest. The market's topped in
January and not at the end of the year. So those would be my paranoia points for that view.
Yeah. Yeah, and I mean, this is where I guess Bitcoin is the one that went to new highs, right? In the second half.
But this would be the first time in a cycle that none of the rest of the market did. And
totally.
we have these first times as well, because last time, if you remember the bear market, it had never taken out the previous bull market high, and it did last time around. So there's always some nuance where some old rule is broken.
And as I've pondered ETH and Sol here, going back to their former highs, the way that I've come to think of it is the whole market is focused on fundamentals. And when I say fundamentals, I really mean it not in values, but I mean fundamentals of what are cash flows, what are buybacks, like what is the supporting structure to the valuation of this asset, right? And so there's a fixation now on fundamentals. And that's, for example, why Hype has done well. As an example, it has strong buybacks due to its profitability. And people have said, okay, well, that's destroying the long tail, with the exception of names like Hype that have fundamentals in their favor. But I think people aren't fully acknowledging that it's also hitting ETH and Sol, and that ETH and Sol in 2021 were excused from fundamentals. And actually, if you look at ETH as a multiple of fees, it is much more expensive today than in 2021.
You and I have talked about this in the past. I think layer ones are excused because of Metcalfe's law. They're not. It's not about the cash they generate at protocol level, but the amount of economic activity that happens on the network. And when I back out that, I find that it's much more consistent with how things are valued. When it comes to growing your crypto portfolio, your number one priority should be to use a platform you can trust. And that's why I recommend Gemini. It's one app that's secure, trusted, and has all the tools needed to buy crypto and build your portfolio. They've been around for 10 years, and their commitment to keeping users safe gives confidence when investing. With Gemini, you can buy crypto in just a few taps and then choose how you want to build your portfolio, whether it's staking Solana or ETH at 6% APR, setting up recurring buys, or trading with advanced tools. In addition, Gemini's Active Trader gives you professional-grade tools like custom views, charts, and alerts, so you can trade and manage your portfolio all in one place. Terms apply. Signing up is free. Start investing today at gemini.com/Real Vision.
I think that is, I think the verdict is still out here. I think like the Metcalfe's law work that you've done is great. I think it is interesting to still look at these things as a multiple of fees or REV.
I think certainly for DeFi, the multiple of fees makes total sense.
Really what I think it will all come down to is what do these things yield? And I think that they end up looking like, the staked assets end up looking like T-bills for these digital nations. And I think that their yield, like the yield markets will figure out the valuations, right? Based on true fees paid. Because I think we'll get out of some of this boom bust, which I think relates to some of the Metcalfe's law stuff of driving things over time. And we should, especially with stablecoin use, it should just become more consistent, right? And less boom bust. And so my expectation would be that, hey, if Ethereum is an older network that's more widely used, okay, I'll tolerate, 5% yield on this thing staked, truly coming from transaction fees, not coming from inflation, right? And if ETH is yielding me 5%, then I want a minimum of 7% from Sol, right? And if Sol is yielding me 7%, then I want a minimum of 9% or something from Sui. And I think that the asset prices themselves will recalibrate, right, to accommodate those yield levels. And so I think that's where this ends up. It's the simplest kind of deduction down to what matters for the critical mass of people that hold the asset, which in all these cases are the stakers.
That makes sense. It just feels like we're not there yet. The market has an inability to price consistently.
I think we're getting there because, and this is where, if we are going into a bear market, I think there is a bit of a reckoning where already the long tail has been in a bear market, right? You could already say the long tail's been in a bear market basically since Q1 of 24. And so that's the canary in the coal mine. I think that a lot of the valuation stuff is going to come for ETH and Sol and BNB and Sui and these names. And people are going to start to ask, the more high growth and the more anticipatory the gains of the asset, the more it will be excused from this exercise. But the more mature the asset, I think the more people will look at it as like a digital nation state T-bill. It's high growth, right? It's emerging markets.
And also, the more you forgive them in the first cycle or earlier cycles, the more they get punished in the bear market, generally speaking. I mean, that's a pretty strong rule of thumb is, a lot of things, we saw it in ETH's first down cycle. We saw it in Solana's first down cycle. We've seen all of these things. They get obliterated in the first down cycle because there's not enough proof of the value of the protocol yet. There's a hunch, there's a forward extrapolation, but not much proof. So we then overshoot the other way. So I'm going to share some things with you in a sec. I haven't told the producers, but I'm going to share some charts just to chat you through some of my views. But so if we are in a bear market, what probability do you say, would you ascribe to, hey, look, I think we might be in the usual 12-month down cycle?
70%, 70%, 65, 70%.
Okay, so you're pretty convinced of that. And in your working framework, do you think it's as deep as normal bear markets?
No.
Or okay, interesting.
Yeah, and that's where I think it gets trickier here. So it's like, if I look at Bitcoin, and I got another screen here, but like if I look at Bitcoin's 200 week is at 55K, right? So that's kind of where I always first go to. And Bitcoin has really respected its 200 week in 2015. In 2019, in the COVID crash, we went beneath it a bit with FTX sales in 22 and 23, but 200 week has been a pretty good barometer. That is like the extreme level for me, right? Because at 55, you're 70 off of 125, you're 56% down. That's a lot less down than previous. Previous was about 80%. Before that was 85%, right? So you're way less down. And I can see something more like 50% down, which is 62 and a half. Okay. I can even see 70, 75. Basically, you defend the Terra flows, right? Terra flows, I think we're around 74, 75K for BTC.
And then the risk curve is the lower the market cap, generally, the more they'll fall.
Exactly.
And the long tail goes down 99%, as it often does. So a quick break in your regular programming. If you're serious about your future, grab my free report called Prepare for 2030. I think you've got 5 years to make as much money as possible, and this guide will help you navigate what's coming. The link is in the description. Download it now.
Yeah, and so, if we defend Terra flows, that's a 40% drawdown. That's like hardly a bear market for crypto, right?
Yeah, don't forget, in previous cycles, we've had like 30% pullbacks.
Yeah, you could still make an argument that we would still be in like a Bitcoin bull, right? If we bounce from that level. And again, what's frustrating with a lot of that stuff is like whether you're bullish or bearish depends on your time frame, right? You give me a 10-year time frame, I'm bullish, right? You give me a tactical, 3 to 9 month opportunity from a month ago, and I turned a little cautious. Not even what I would like categorize as, oh, Chris is bearish, So yeah. And then I'm going to be really interested to see where ETH bottoms, where Sol bottoms, where a lot of these names bottom relative to their prior lows, right? Because
it would also be a weird cycle, Chris, because Bitcoin dominance hasn't moved in the way that it normally has.
No.
It's like there's so many parts of this that would be confusing. Now, it doesn't mean, this time is different. One thing you're saying is the same as the 4-year cycle, but most of the structure of it would be different, which is fine too. These things can happen. But I'm just, that's another thing I would say is like, that would be weird.
Well, here's what I'm prepared for. So, do you remember how in 2021 people were calling Bitcoin like a pet rock, and they were like, people were not having Bitcoin as an asset? Because in 2021, Bitcoin basically 3x'd, right, from the 17 high to the 21 high, and from its bottom it went 3k to 3k to about 60, 70k, so about 20x. So it basically did, for example, from the bear low to the high in 21, it basically did what Hyperliquid did this cycle, if you nailed Hyperliquid at the low and the top, right? Just for a scale of like how much these returns have changed the cycle and why people are mad. But where I'm going with this is Bitcoin was unpopular in 2021. It actually traded beneath its 200 week in 22 and 23. And then it had a great cycle because it was so unfavorable, right? Or out of favor. Now it's so in favor. There is a world where it actually underperforms into the next cycle, where if it follows more of this logarithmic channel, the returns mute quite a bit, right? And people go too heavy into Bitcoin, this bear, because they're like, well, Bitcoin's the trade. And I still think, knowing all this, I still think if you're in crypto, you should have a very significant Bitcoin position.
There's another probability we have to weigh up, is that something goes horribly wrong with MicroStrategies and Bitcoin underperforms ETH.
MicroStrategy and all the DATs. And so I think there is a world where, you know, Bitcoin has gone from being the darling to being out of favor. This cycle is the darling. There is a world for it to disappoint from the next bear into the next bull, not provide the type of returns that people expect, and those returns to come in a few other more unexpected crypto assets.
So how my framework, one of my big lessons learned is every time I override a kind of macro framework with emotion is when I've kind of got it wrong really badly. 2009 was my worst year because of that. And so I've got this very robust framework called the Everything Code. Again, probabilistic, because I'd say, well, you say seriously, there's many other outcomes that can happen. But I got to this weird thing where I started realizing that the ISM, the business cycle, was a perfect 4-year cycle until recently. I'm like, what the hell is going on here? What's gone wrong with this cycle? And the work that I'd done was, this was all a 4-year debt maturity cycle. And because in 2008, we had a debt jubilee and everybody forgave interest payments for 4 or 5 years. And what they did was restructure their debts to this 3 to 5 years cycle. And we got this perfect cycle. This is the Bitcoin halving cycle. This is the whole thing. And then suddenly it stopped. And I'm like, interesting, because I calculated this 4-year debt cycle. I think I was the person who discovered it. So I went back and recalculated. And what I found was in 2021 and 2, because rates went back down to 0, they pushed it out another year. So it got to about 5.4 years. So I'm like, okay. So then when I put it back on a little sine wave, you're like, oh, that sort of makes sense. So we're still in the trough of the cycle, and we should be coming up with the business cycle growing because we've not had it grow. And then out of that, you know, I've obviously been using liquidity as the main driver of all of this to finance the debt. So here's the interest payments that come due. And here is the liquidity to match it. And this is total liquidity in the US. So that's the Fed net liquidity plus banks and M2. And so that's where the money has to come from to finance the debts. Okay, so it makes sense. And then when you look at it, how I use it is financial conditions, which for us is the dollar, rates and commodities, leads total liquidity by 6 months, which leads ISM by 6 months or 3 months. So you've got this 9-month lead of financial conditions, which suggests that liquidity should pick up and the business cycle picks up. So that's the framework we've been using, and it's very good. So I'm like, okay, this is interesting. It's persistent over time. So we know that the ISM, so liquidity is the main thing. The ISM is the driver of the economy, and financial conditions give us the lead. When we detrend Bitcoin and put it against ISM, it's the same thing. So what it's telling us is Bitcoin is subdued because of the business cycle. And the reason the business cycle is subdued right now is because it's not the debt rollover year this year, it's next year. It's the next 12 months. So it's like, oh, okay. So the debt rollover year is the thing that makes the difference. And then you look at the correlation between, this is global liquidity, so we're assuming all countries do it.
Mm-hmm.
It's pretty closely correlated, and we've seen global liquidity picked up and it's pulling back down. And that gives us a R squared of 90% and 97.5% versus the NASDAQ. So it's like it's the most dominant macro factor in history, driven by the debt refinancing cycle, and the business cycle is a component of it. The business cycle has been lackluster for a number of reasons. And then when I look at this is US total liquidity against the crypto total market cap X Bitcoin. And basically it's the same thing. Now, recently we hooked lower because of this lack of liquidity. And this has been slightly overvalued. And every time we've got there, we've kind of caught up. And so the bet to me is, if I extrapolate all of this away, the question is liquidity going to have to rise because of this or not? Because if it is, the correlation of liquidity is so high that I would be ignoring the biggest macro factor we've ever been given, and nothing would work. And then I go, the other way I think about this is, okay, well, the business cycle, if Scott Bessent talks all day about we need to get Main Street to have money, and we've got stimulus coming in terms of fiscal, and we need to get, Main Street catching up with where Wall Street's been, that tells me the business cycle needs to go up. Earnings need to go up. Corporate earnings, household earnings, and not just the Mag 7. So if they want to win the next election or the midterms, this is the game to goose. And what's interesting is Scott Bessent's a macro guy. So that's what's in my head. And I find it hard to walk away from all of that. But I also see that the structure's not great and the markets are sloppy and all of the things that you say.
Yeah. Well, it's your own paranoia, right? We basically have opposite.
That's why I wanted to talk to you. That's why I wanted to talk to you, because I wanted to hear. I want to hear the paranoia, because I can confirm my view to myself all day.
Yeah, of course.
But I need to hear the whispering voice in my head to say, "No, Raoul, you're a moron." That's the most important voice.
It wouldn't surprise me if you're right, but you're just a little early, And it's the debt refinancing year is 2026. Right. And
well, it is. That's the point. So it's kind of, I can't see how we get a bear market unless all liquidity leaks into an AI bubble or something else.
Well, I guess that's what I mean is like, okay, crypto Twitter is so fast moving, right? And I know we both experienced this where like there's a type of audience capture that comes from the impatience of crypto Twitter. And it's actually one of the things that like I've been spending quite a bit less time on Twitter of late, because I'm like, this is actually, not only is it unhealthy for me as a person, it's counterproductive to my investing ability, because there's so much pressure when you appear to be wrong, even if it's just a duration thing, right? And like, I've had periods in for example, in 2021, I didn't venture invest that much. It was a gangbuster year. I didn't underwrite that many things. I got a fair amount of pressure for, are you still in the market? Are you still relevant? Like, there were questions from different places that I had to endure through 2021, even though it was ultimately the right thing to not be deploying that much capital in 2021. But that only became apparent by the end of 22. And so it took about 2 years, and then by the end of that 2-year cycle, let's say when I want to go buy Sol, the people that were, questioning me, let's say in 2021, then don't have the conviction to buy Sol at the end of 22. Right. And so it's this type of thing. And I think crypto Twitter is the worst for it, because anyone can comment on anything. And so there's pressure on kind of these longer duration views where you can ultimately be right, and it causes a type of buckling to that pressure, which is just counterproductive.
Yeah, I mean, it's hard. Look, you've had a lot of abuse. I get a lot of abuse endlessly from trying my best to actually help people. Just want to understand something. I'm guessing you have a bias in how you invest, that you'll take money off earlier, but you'll be earlier to pick bottoms because bottoms are easier than tops. And I've sensed that that's your structural bias, which is
correct.
Pretty good because it's very hard to do both well. I mean, I think I'm better at buying bottoms than I am selling tops as well. They're hard. So you would rather be early and take that stress off your mind than you would.
So you're very well noted. And, there's a few structural biases. One of a good friend of mine, actually two of them, who are excellent traders, they just aim for the shoulders and above of bulls and the knees and below of bears. And it's like, it's good enough. If you exit, ETH between 4 and 5K or 3,500 and 5K, that's good enough if you were buying it between, 1K and 2K type of thing, and apply that to every other asset. So shoulders and above, knees and below. And then another one, Joel, actually, my partner at Placeholder, cued me into this. JP Morgan apparently was asked, how did you, do so well in life? And he responded by selling too early. And that always just makes me, chuckle, because he went through a lot of booms and busts, right? And I'm sure he was eating shit from the masses or different people who are like, I'm making so much money, how come you're not in this trade? While he's taking profits. And it was very boom bust in the equity markets, right, in the early 1900s. But he's stacking cash while everyone's, really ebullient and proud of themselves, such that then he has cash when times are not so good. And so it's kind of one of those simple things of like, I will feel it too, like when ETH was ripping and Tom Lee announced his 20 billion at the market facility, and, that was late summer, right? That was a crazy time, very euphoric. Like, I would argue that was a banana zone, right? And I had to step back and be like, wow, I feel really good. People around me feel really good. People on Twitter feel really good. Like, that's just a time to be taking some profits. And, of course, if I share that, people are going to be like, you're an idiot. Why would you take profits here? ETH's going to 20K, but you just got to withstand that.
If you'd have looked at that liquidity chart, would have told you the same thing, which is liquidity wasn't going up fast enough for the market to accelerate.
And we bumped. That was what you showed. That was that red bump, right? It stretched beyond liquidity.
That's right. And the reason being is it was exactly then in July when the M2 chart decoupled, all of these charts decoupled. And we're looking at this thinking, what the fuck is going on? And we realized for us, the explanation is it was the TGA rebuild. Suddenly they started ramping up the rebuilding of the TGA, which was withdrawing liquidity, and there was no reverse repo left to drain. So suddenly it was a big event. And then we had the government shutdown. But that was, your intuition was perfect within that because it got to the top of the range and there was no fuel to that fire. So it just it nuked again, as did Solana, because it just, if not, we're just doing rotations. We're just circle jerking all the way through crypto. And, that's what I'm trying to figure out right now is like, is Zcash, which is a very clean narrative that I understand perfectly, but is the signal here this is just a rotational circle jerk within crypto again, or is this something meaningful? It's really hard to know.
It is. And, I've been deeply involved within the Zcash community, and so I have some bias here, right? I'm friends with Zuko. I sat on Zcash Foundation, set up a grants board that I sat on for their first year. And so there's a lot of emotional affinity, let's say, that I have for this protocol. And in 2016, when it launched, it was the most anticipated coin, right? And it launched at a multiple of Bitcoin. And at that time, it was a better Bitcoin, which is the same narrative that's coming back now. I share all that because I'm biased, right? And I am long Zeke, and I do believe in the protocol. That said, so I'm going to paint both stories, and I'm going to paint what I think is going to happen. Zeke is ripping, but so is Dash, and so is Monero, and so is Decred. So are a lot of these OG privacy coins. Now, Zeke is ripping the most. So that's a difference. It has done the best, but all these privacy coins are ripping. Some of the like more kind of like long running Bitcoin OGs, so people that even predate me in the Bitcoin industry, have cued me into some things. And again, I don't have the hard data on this, but like that apparently, some Bitcoin whales will use some of these coins to, anonymize their profits end of cycle, juice a bit more return. Like there's all kinds of things that like you get whispers of that I don't participate or dig deeper on in this industry. But there's kind of that explanation for, well, why do all these privacy things run at the end of a cycle would be what one explanation. The truth is we are not going to know until or if we get a bear market and we see where these assets bottom. And, if Dash and Decred and Monero and these privacy coins all go back to the bottom of their ranges, but Zeke holds materially higher, a materially higher low, that is very strong signal to me. So I think Zeke's 50-week moving average is at $50.
And what happens, Chris, if your base hypothesis that the cycle is over for now or over and it keeps going? I mean, how do you deal with that? How do you deal with, look, you fundamentally believe that this could be a very big thing and its percentage market cap versus Bitcoin has to go up over time because privacy is going to become a larger deal. And I get all of that. How do you deal with that? Or do you just have to remain fundamentally long and just forget about it and extend your time horizon?
Well, so
and hope to buy more in that sell-off if you get it.
Yeah. So I would say, like, personally, I have an amount of Zcash. It's not astronomical, but it's an amount that I'm happy with that I will never sell. And I kind of treat it like an amount of Bitcoin that I will never sell. And the only way people did phenomenally well from Bitcoin being $1 or $10 or $100 or $200 is basically just being like, never sell, right? The HODL mentality. And so there is, a portion of Zeke that I view that way. And then for me, when people ask, hey, what are you looking at? Especially if there's a incoming bear, the opportunities of the next bear will be most obvious from the bottom of the next bear. And these assets reveal so much about themselves in where they bottom and how they bottom, right? And for me, like right now, I look at Zeke and I love that it's cleared its 2021 highs and it had a monthly close higher than anything it had in 2021. And so I think that is a point in the right direction, right? Because right now, I was talking with Barry Silbert about this.
As we both were. He was shilling both of us.
And you got to listen to Barry. Barry's a wise man.
He's annoyingly right. He's been telling me about Zcash forever. And I'm like, oh, stop going on about it. And then he calls me up and says, see, I told you. I'm like, yeah,
the one where Barry really got me was Ethereum Classic. I remember I was at ARC when Ethereum had just forked. And there was ETH and this bastard child other asset. And I had some OTC desks calling me, asking me about if I knew people that wanted to sell ETC. And it was the first I'd heard of the ticker. I was like, ETC, what's that? And they're like, oh, it's Ethereum Classic. And like everything was getting branded in real time. And, Barry ended up creating a grayscale trust around Ethereum Classic. I don't know for sure, but I think Genesis or maybe DCG took a position. I don't know any of this for sure. But what I do know is, because ARC was down the street from Barry, is like, I would say Barry was instrumental to making ETC a thing. And for me at the time, I was like, this is ridiculous. Why would anyone buy this like valueless asset? Like sell all of it you can. That was the view. That was the predominant view at the time. And here was, someone else taking the opposite view and really kind of, dreamed ETC into reality, and it was extremely lucrative. So anyway, I have a lot of respect for Barry. You do too. And yeah, Zeke is, so it has cleared its 2021 highs, which is important, but it's basically back at its 2017 highs. And it's the reason I brought up Barry is it's been this like wildly volatile ranging asset, right? If you look at it over on a weekly or monthly basis. And so it's kind of this problem child where most crypto assets are value destructive. There's a very small set that are value creative, right? Or value constructive. And Zeke is kind of a Schrodinger asset right now, right? And we all, like anyone who's been in this industry for a long time knows that, Zuko and his team are as hardcore cypherpunks as you could come by, right? Their contributions to zero knowledge technology are above anyone else in the industry, right? They've really been a bellwether of these things. There's all the exchange integrations, the lore, all these things that make Zeke a great asset, but it's still been a problem child in the markets. And so what I'm really watching for is even if it keeps going parabolic, I don't trust that parabolic move. I wouldn't chase that parabolic move. And this is why I haven't been on Twitter being like, yeah, like Zeke, because I don't want to be responsible for people then later, being like, you told me to buy this thing in this parabolic move.
It's because it's an unproven narrative right now. As you say, the best thing is the retest of the low. The retest in the bear market is the best.
And that is what we're going to need. We're going to need to see where this thing bottoms when this heat comes off. And, if Dash is selling off, is Monero selling off, if Decred is selling off, everything else is selling off. I really want to see, does Zeke go to 50 or 60, which is where its 200 week is? Does it bottom at 100?
I want to play the other scenario that my thesis is right and 26 is a very strong year for crypto. And we have some correction. It corrects down to 250. Let's take a random number. Stabilizes and then rips higher and ends up at 1,000 by the end of 26. Do you do anything, not do anything, kick yourself, or just hold your core position and say, it is what it is. I'm just going to have to wait to lean into it?
I'll make the decision based upon what Bitcoin does. So and this goes back to that anchoring of, Bitcoin needs the tides. Bitcoin needs to turn the tides, and the tides need to turn around Bitcoin. Maybe a better analogy to use would be like, there's these very large ocean flows, which are called thermohaline circulation. That's like macro, right? And then that comes in and that hits a reef pass. And that reef pass then creates current. That would be Bitcoin's flows within macro. And then there's all these nooks and eddies and corners to that reef of all the microstructure. And so you got to pay attention to the macro, pay attention to how Bitcoin changes within that. And then once I'm reasonably assured of Bitcoin having formed a bottom is when I get quite interested in, okay, where is everything else that's, a really quality asset? Where is it priced? And what is the opportunity?
Another thing I want to think about is we've had the liquidation. There's no real leverage left in the system. But I think there are some risks still. There's the DATs that we've talked about a bit. We don't really know how they behave in a bear market when they're trading at a big discount to NAV. The other one is these kind of yield-generating stable coins. We saw a bit of what happens when they unpegged on Binance.
Yeah. And we've seen the story before.
And I worry if I put the main players in this together, they've probably got like 18 billion. And basically they're risk arbitrage hedge funds. But I don't see them as big in the market. So that concerns me. There's always a red flag to me. If somebody in theory has a lot of leverage or positioning and it's not seen, that worries me.
Yeah. And I've really started referring to those as like yield instruments more than stable coins. I think they're really interesting yield instruments, but I think it would be better for the industry if we thought of them as yield instruments, like stable-ish yield instruments, to imply the risk that's in them rather than stable coins.
Yeah, I think that makes sense. Final question for you. My thesis has been that we've had almost no inflows into VC, liquid hedge funds, etc. We've just seen ETF flows, and that's it. Why is that? I know we've had an AI boom, but why has crypto failed to attract the capital flows that it's normally had? You're normally fighting off new investors in VC, but most people aren't even raising funds right now.
Yeah. Well, definitely like the bubble is in AI, right? So that's just sucked all the hot air out of the room, right? So I would start there.
Which is good, probably.
Yeah, I would say it's healthy in aggregate for the industry. At the same time that we've talked about this oversupply of coins, right? And so I would say the token industrial complex has come to an end, right? Like people have kind of realized ways in which it works, ways in which it doesn't work. I would color myself as like optimistically naive at a point of time, at a point in time, and I've had to basically disabuse myself of some of that naivete. And now it's like the valuation gongs are ringing, right? And so now everything needs to justify why it's valued the way it is. It's a combination of that with flows, right? And I think flows are so key to any asset. And like very simply, for example, I have this conversation with the Celestia team a lot. They need to get to a place, and as they've gone through their unlocks and everything, that they're getting to a place, and especially if they reduce inflation, where they will have such little inflation, call it 25 basis points with proof of governance, that if there's a lot of demand for their data availability, they could turn their flows such that there's a structural bid, right? BNB has done phenomenal over cycles because it has a structural bid. Hype has a structural bid. Bitcoin and ETH have structural bids. And so I think it's going to be a lot of that kind of looking for the macro assets that have structural bids and pulling it back to VC. Like a lot of VC is underwriting the new ideas and the new things, right? Where there are structural flows against you, basically, when you launch those assets in the way that they have historically been launched. So then there's going back to the drawing board, right? Do you launch at much lower valuations, which I've always been an advocate of, right? Do you have there's also a question of, in this better regulatory environment, can you have 100% of supply circulating from day one? Just rip the Band-Aid off. Like Solana famously did this at the end of 2020, December of 2020, Sol was trading down. And then they unlocked something like 80% of their supply in one day. And then from that point onwards is when Sol went on its crazy 1-year run from December of 2020 to 21, because you had true price discovery. I'm trying to connect a few dots here, but what I want to say in aggregate for venture is, for crypto venture, I would say the form of crypto token venture that has been, performed and executed over the last decade or so, is definitely under duress. And so I think people have to go back and look at that model. There's more funding of true companies, so companies that make money, say in the stablecoin sector, or these kind of more mature, call it TradFi sectors, or there's playing at a much smaller, lower valuation scale. The other thing I want to say though is something, a few realizations I've come to over the last year, let's say, is a lot of the distribution of blockchain technology is being hoovered up by big tech and big finance as we get regulatory and legislative clarity. And though big tech and big finance have tens or hundreds of millions of users that they can funnel to these protocols. And so I think a lot of us were expecting there to be crypto native players that would provide distribution. And there are, in the form of Coinbase. You could kind of say Robinhood is kind of more crypto fintech native than big finance as we know it. MetaMask, Phantom, those are interesting ones. But there's not that many distributors, right, with massive scale. And so now that distribution advantage is coming to big tech and big finance, and that's sucking out a lot of venture opportunity from the top of the funnel of crypto, right? And you would kind of prefer to buy some of those names that are going to benefit. And then at the bottom of the stack are the Bitcoins or the ETHs or the Sols or the Suis or the TIAs, or you pick your flavor, right? And your risk and what you want. But it's a bit of a sandwich now, and everything in the middle is getting stripped of value because it doesn't have pricing power. The pricing power is with the distributors, and then the base layers are the ones that have the aggregate demand, right? They kind of catch everything. and everything in the middle is getting squeezed. The other thing I would say, even when you look at DeFi assets, DeFi is so competitive, right? And global in nature, open source, that any bit of yield, extra yield that you give token holders, you are making, let's just take a borrow lend platform. Let's say you give extra yield to the token holders. That is showing up in the rates that the lenders are paid, or the rates that the borrower pays, and makes those rates less competitive. And so what I'm getting at is, I wrote a piece a long time ago called Protocols as Minimum Viable Extractors. And this is starting to play out, where the protocols are forced to be minimally extractive to the benefit of the consumer and to the benefit of the supplier.
And to your point is, what is to stop, and we've just seen Robinhood make the investment in Lighter, which is a perps exchange. And we're going to see this where people like Robinhood bring these, and Coinbase bring these under their wing.
Yeah.
Because they have distribution.
Yeah.
And Hyperliquid, yeah, in crypto land, they've got decent distribution, but in Robinhood or Coinbase land, they've got nothing.
Yeah. And so I think that's tough for venture, right? Because there's consolidation at the top and there's consolidation at the bottom.
Do they not buy businesses from you? So if you've managed to find something early, you get in at the $20 million valuation, do they not end up buying this stuff for 100 million or 200 million, as opposed to like Kobe's just done to Coinbase?
Yeah. And there is some of that, and I saw Arthur Hayes is raising a fund that it looked like to me was a fund to buy distressed assets or something.
Growth state, more mature, just not sure.
Yeah, and so I wonder if that's what he's thinking, right? If he's going to, because there's a lot of companies that are kind of in this middle market that aren't making enough money that could be bought and rolled up for very cheaply, or repackaged for TradFi or whatever it might be, a type of like crypto specific private equity, we could call it distressed private equity. So, but there's no doubt that, the season has changed and the strategy has changed. And, I find myself gravitating towards large positions in liquid winning crypto assets. You can get amazing multiples off of venture investments, but the cash on cash returns have always been biggest in the large liquids bought and sold at the right time.
My thesis has been that for a long time, is you actually make more money out of liquids if you get the timing decently right than you do out of VC, and in a hyper concentrated period of time as well.
Yeah. And the good thing about that is that opportunity is available to everyone, right? But it goes back to the start of our conversation, is like, you got to be comfortable doing the kind of boring thing, and like BTC is really exciting for anyone that's like, not a Zoomer or a millennial, right? It's a high octane asset, right? So like, hold the high octane asset and hold some of its friends and let that value compound. And then that the great thing about that is that opportunity is available to everyone.
I think what we will have left people, you've given some amazing advice with all of this. I still think they're going to have no idea how to deal with whether this is a top or not a top. And that's the
thing is, you and I don't know. You and I don't know.
That's the nature of the beast. We can talk about it all day. The price is the arbiter. And that's the hard part about all of this, is you have to be grown up enough to realize that in the end, price will tell us how it plays out. It's the perfect scoring, and it's hard. And if you can't stomach being wrong, then you've got your portfolio structured wrongly for your risk tolerance. And that's always the outcome. Like you say, hey, if I'm wrong and I see Bitcoin basing again after this correction and it does something differently, I'm prepared to change the probabilities.
Yeah.
And you put yourself in a position that you can do that. You've got the flexibility to do that. A lot of people don't give themselves the flexibility to have a change of opinion.
Right. Right. And yeah, the key, I think, is always having some exposure to Bitcoin and then raising cash and having that cash buffer come and go depending on the opportunity you see in the space.
And I've done both ways. I've ridden full cycles. The 2013 cycle, I rode that all the way up and down, and then continued it all the way through to 2017, then took money off. It too early, way too early, when Bitcoin was at 2,000, it went up to 20,000.
Wow.
And then I didn't take any off last cycle and just added like crazy into the lows, and that worked really well for me this time around.
Mm-hmm.
And then this time around, maybe I'll take some off, but I certainly won't take most of it off, because my time horizon is like, this is the best wealth compounder, and don't screw it up.
Stay allocated to capitalism.
Exactly. All right, my friend, as ever, fantastic conversation. It's really good to see you, and thank you for coming along.
This was
I know
excellent.
you keep
Thanks,
a low
Raoul.
profile, so I do appreciate it.
I do, yeah. I haven't done an interview for a while. I can't remember the last one I did, but when you asked, I was happy to do it.
Amazing. All right, my friend. See you soon. Look, what a great conversation. Love talking to Chris always. I love having divergent views. You know, things get reduced on X to I'm right, you're wrong. That's not how the world works. The world works from nuance, understanding, and discussion. So when we both get to explain our views, we both get to understand the differences. And the differences are, mine is more driven by data that I use. Chris is more driven by intuition from market feel, structure, and understanding. Now, that's not to say one version is right or another. Again, it's all about probabilities. But learning how to navigate it, that's the magic. The magic is not in a year-end forecast or a next year forecast. It's how to navigate these times psychologically and within your portfolio itself. I hope you found it useful. See you next time. So you obviously liked this video enough that you've got to the end. That's quite a big task. But listen, do me a favor, hit the like and subscribe button, and also check out what video's next, because I think you'll love it. But if you want even more, and when I'm talking more, I'm talking about member-generated ideas, incredible alpha, research, everything there to help you in your journey, just head to realvision.com/join for the best financial intelligence out there and the pure alpha that's within the platform.